Lonsec wishes to remind that the information we provide on our portfolios is general advice, and we encourage investors to read the PDS or seek professional advice prior to making any decisions on their investments.
Hi, I'm Martin McGrath from Financial Edge Group. Today, we're fortunate enough to be sitting down with one of the experts in the industry. We work very closely with Lonsec, and we're fortunate to have Lucas to help kind of answer some questions about what's happening in the market at the moment. And so let's dive into some questions with Lucas. So Lucas, the markets have returned pretty positive returns in the last kind of 6 to 12, 18 months on the back of pretty volatile times. Will this continue? What's happening in the market? Where do you guys see things at the moment?
Yeah, returns across most asset classes, if you look over the last 6 to 12 months, have been fantastic. So it's been a great outcome for most clients out there. Certainly, from our perspective, returns have surpassed expectations. I think if we look ahead, there are, I guess, some red flags starting to appear in terms of the market. That's not to say that returns may not continue to go as they are. But if you think about what has driven markets over the past 6 months, you've had very supportive central banks. So effectively, central banks have done everything to ensure markets are stable. You've had very low interest rates. So if you're a company looking to borrow money and what have you, the cost of borrowing has been very low. And overall, earnings generated by a lot of companies has been very strong. So it's really been a culmination of a variety of things that have supported markets. Now, looking ahead, what we are seeing is that central banks are looking at maybe tapering some of the support they've been providing markets. Interest rates, there is a question mark at the moment as to will interest rates go up. They've been at historical lows. And earnings, we've had some record earnings and whether that's sustainable. So the three things that have really propelled markets, there's a few questions going ahead. So I think what we'll see is more volatility in markets, more dispersion between the winners and losers, whereas, go back several years, everything went up. And so you are going to have to be a lot more selective in terms of where you invest in.
What do you think kind of is the concern? The markets were at all-time highs or close enough to. We've seen, I suppose, a bit of pullback in testing the waters in the last few weeks. Do you think, another pandemic outbreak or a government thing or a political item around the world being potentially that biggest risk factor? Obviously hard to know. There's always factors that change the markets, but is there anything that you guys suppose are keeping your eye on or certainly conscious of?
Absolutely. So I think, there's always risk there when you invest in money and ultimately you get paid, hopefully, for taking on that risk. But if in terms of what we're focusing on, probably the one key one we're looking at is policy risk. So one of the things that no doubt maybe some of your clients have seen in the papers and so forth is everyone's talking about inflation, costs of products going up, oil prices going up, all of these sort of things. Now, that's not unexpected as the pandemic has sort of played out. One of the challenges has been that a lot of supply chains have been impacted. So the ability to move goods and services across, internationally across borders, there's shortages, and that has put up prices. I think the concern is that maybe there's a more structural, long-term impact on inflation. And I think, so the biggest risk is, as I mentioned before, interest rates have been very low. And one of the risks is that we get inflation that gets beyond just supply chain issues and more structural, and the central banks don't respond in time. That's a real plausible risk, and it's a hard one to predict. Other risks, look, there's always the chance of COVID, I guess, ramping up again. Depending on where your clients are located. I mean, we've all been sort of in lockdown at different periods of time. We've seen, that has hampered some industries to a large extent. Interestingly, when we look at the data from an Australian perspective over the last several quarters, we have noticed the impact, the negative impact of lockdowns on some of those economic indicators, whether it's manufacturing or whether it's the services industries. They have been adversely impacted. So, if we were to go back into that environment, no doubt that would have a negative impact on some industries. And then the final one that you sort of alluded to was, geopolitical risk. That is a bit of a harder one. Geopolitical risk is always ever present. Obviously, the one that's sort of focused at the moment is China. So we don't try to. We do discuss it, but we're trying to sort of really sort of understand what would be the longer term implications, because you don't want to also be too reactive from an investment perspective, because we just live in a world where there is always geopolitical risk, and it actually sometimes isn't always bad for markets. One of the interesting things from an Australian perspective, so we have seen interest rates go up in other countries. So New Zealand, for example, have raised rates. I think Norway has raised rates. One of the things from an Australian perspective is, yes, we've seen some inflation in certain goods, and services. But one of the areas where we're yet to see inflationary pressure is in wage growth. So from an Australian perspective, unlike in the US, for example, where they have had wage growth, from an Australian perspective, we haven't had wage growth. Anecdotally, people will say, there's a shortage of workers in, if you want to hire someone in a cafe, for example, it's very hard to find people to work. But more generally outside, more broadly, wage growth hasn't really been there. And so our sort of base case is, yes, there is inflationary pressures, but we don't think that in the short term rates from an Australian perspective will go up. I could be wrong, but wage growth is something we've been watching very closely, because that is the thing. And the RBA has pointed to that for some time. If we did see wage growth, we'd see that we do think then the rates will be more likely go up. And then to the second part of your question, rates going up, generally speaking, asset classes such as, bonds, asset classes such as listed property, infrastructure, these sort of assets generally are adversely impacted by interest rate rises, because they are more sensitive to interest rates. But the key thing is to note it's the extent. It's the materiality. So if you think about inflation more generally, inflation actually isn't always a bad thing. It's what type of inflation. If you get out of control inflation, that's bad for every asset class. If you get moderate inflation, it's actually not too bad. It's not too bad for equities and so forth. So it's more around the extent. What I would say is that the way we sort of think about it, while we don't think out of control inflation is the base case, so to speak, we still want to ensure that portfolios have some level of exposure to assets that would tend to do okay if we did see more inflation. So, there's a lot of variables. I think at the moment, there's probably more unknowns than knowns today. So diversification is important from a portfolio perspective. But our base case still at the moment is that we're not going to see rates go up aggressively from an Australian perspective. We run a quarterly investment committee, which we talk about, these sort of things. And it's very easy to get, there's a lot of noise in markets, and the papers will always pick the one topic that, it's the topic of the day. And look, it's important to be aware of those things, absolutely. But it's also important to have a very clear process that you remain focused, and then that you're not just sort of chasing the news cycle in terms of from an investment perspective. So I think, inflation is absolutely relevant. geopolitical risks are absolutely relevant. But at the end of the day, what you're trying to work out is well, from our perspective, what impact is that going to have on asset prices? So, at the moment, most asset prices are pretty expensive. What impact is that going to have on the economic cycle? So, do we expect that to slow down, or is it going to ramp up? They're the sort of broader things we want to focus on. So when there is these sort of news, it's how does that feed into that sort of prism of thinking of, what are the implications of the asset classes?
Our specialisation is in retirees, and we use a certain bucket approach to make sure they've got cash reserves to allow to kind of focus on markets ups and downs. That even if you're retired, yes, you want to be more conservative, but you've got 20 or 30 years that you want your money to last for. So your diversification point of view is bang on, and we focus on that. But in that, let's say that if different clients, it's different, might be 10, 15, 20%, we're in cash or fixed interest. We are in a low interest rate environment. In terms of, I suppose, part of that, we get you guys involved to help manage that. But in terms of trying to get a return in a low interest rate environment, and people just accept that we are getting lower return but lower fee or risk, where your perspective of interest rates and how to get a return in this kind of environment on the defensive side?
Yeah, it is in terms of that defensive side. So you get little reward for holding cash in terms of returns. At the moment, we all know that, and even on fixed income, it's challenged at the moment. So from our perspective, when we're thinking about, like if you sort of rank order, okay, where do we think, just more broadly, you're still going to get a return. We still do think that your growth assets, equities, for example, you're still being rewarded for taking on that risk relative to cash and bonds. The dilemma within less so cash, but say bonds, is what level of risk do you want to take? So we've always sort of been of the view that equities, people sort of tend to understand. Equities, you take on risk. Equities can be volatile, and that's pretty clear. Within bonds, obviously, it's a very broad church of assets. You've got assets that are pretty conservative, but then you've got assets that, arguably are very high risk. And from our perspective, you don't want to be just chasing high returns in fixed income, because as you take on and you go up that risk curve in terms of fixed income, they do behave more like equities. So you're sort of doubling up on that equity risk. So what we are seeing, though, at the moment is it does pay to be active in that fixed income part of the world. I mean, just interestingly, the month of October, global bonds, for example, the benchmark returned -3%, and that is because the what you did see is 10-year treasuries basically go up. It's in a perverse way, when those things go up, it actually is not a good thing for bonds. So it's a bit in reverse.
Yeah.
But the reason I point that out is that from an active perspective, we did see a lot of the active managers do relatively well against that benchmark. So it is an environment that we would argue you need to be more active in your allocations to bonds. And the market does move. So maybe if I use one sort of example, and for retirees, when we had that sort of in the depths of the COVID period, and if some of your clients may recall, last year, and the markets, went down, when it was sort of everything was, the markets locked up, COVID was in train, and markets went south. Interestingly, and at the same time, clients may remember that a lot of Aussie companies halted their dividends or reduced their dividend payment amounts. And so in that environment, it's like, well, where are you going to get income? And with every sort of downturn in market, opportunities come. And there were certain parts of the fixed income market that were generating incredible returns and opportunities for clients, and the ability to be active. And those opportunities closed up. But I guess the only reason I say that, it is an environment where you have to be more active in your approach, because just the set and forget in this environment probably doesn't work as well.
You talked about, I suppose, opportunity, taking risk in some of those other assets to perform more like equities, and at that point you might as well be in equities, and that has come up, I suppose, in some conversations recently with clients. That might be that they've seen an article in a magazine or a newspaper, an advert about a mortgage, and without naming names, but different mortgage funds or unlisted things, all of a sudden are guaranteeing a 4% kind of interest rate return. Obviously, there's risk involved with those kind of investments. Do you want to talk about that for a second?
Absolutely. So, unlike equities within fixed income bond markets, if you sort of think about it, the most simplest way to look at it is any return above what cash is paying is risk within fixed income markets. You're being paid that extra for taking on more risk. The important thing to note that is, though, if for whatever reason, and you get a default of the asset within fixed income, well, that's basically you've basically lost. So it's a sort of asymmetric return profile for fixed income. So what we would sort of say is that just be aware that if you are getting the bigger return, whatever the assets are, they are taking on more risk. Risk is not a bad thing, but I think the important thing is to just note it's not cash.
Yeah.
So it's not your money's not locked up in a sort of cash asset. It is taking on more risk. And if you do, if the markets were, if you had, for example, what we experienced in last year with fixed income markets, where a lot of them locked up, and you did see quite negative returns. So it's a question of where do you want to take risk, and also just noting that if you are getting in fixed income markets any return in excess of cash, that's because you're taking on more risk. Basically, that's it.
Yeah, I think it's a good time. I think that's similar conversation we have, that if you're getting in the moment a 4 or 5% return, but everyone's only paying 3% on their home loan, if you're getting 5%, someone else is paying a much higher rate. They're paying at 8s and 10s, and they might be able to pay that for a while. But as you said, if there's a default on that asset, there's a reason that person's paying 10, and there's a margin being taken, you're getting 5, that the risk for that on the other side, the person borrowing that money, is much higher. And that might be fine for certain months, but that default risk that might exist in a certain market in the future might significantly impact that bit of extra interest you're getting now.
Yeah, absolutely.
Can you talk a bit about how you guys manage risk in your portfolios?
Sure. So from a portfolio perspective, there's a couple of levers we try to use to manage risk, and I guess when maybe it's good to sort of contextualize what we sort of how we view risk. So look, there's many ways to view risk, but I guess fundamentally we try to manage loss of capital. Basically, that's what we think of when we think about risk. So the levers we use is on one side is tilting from a broad asset class perspective, positioning the portfolio for the current, for what we think in terms of the environment going forward will be. So that may be, so at the moment, for example, we are still overweight risk assets. So things like equities, for example, things like infrastructure and property, and we are underweight assets like fixed income and cash. And that's really based on a whole variety of things, and looking at it from a relative perspective where we think there's more sort of opportunities and value in the market. So we do look to manage risk through that broad asset allocation prism. But then importantly, we then look to manage risk through the underlying investments that we select. And at a very high level, when we think about constructing a portfolio, let's take Aussie equities as an example. We'll tend to want to have, okay, what is that part of the portfolio that is going to give us that long-term exposure to the market? Because over the long term, we do think equities, people are rewarded for taking on equity risk. And that may be, just via maybe an active approach or a passive approach, but effectively gives us exposure to the market. We are also always very cognizant of having an exposure to an investment, a strategy or a style of investing that can do or does do better when the markets pull back. So having like a bit of a handbrake. So that sort of exposure to the market, that will go with the market. Hopefully, if it's active, a little bit better. But then having some kind of strategy in there that, what will directionally go up, probably lag when the market's going really well. But when the market has a downturn, hopefully does better than that of the market. So it's about, one is having the asset allocation tilts, and then two, ensuring that within the context of a portfolio, there is some defensiveness built in. And diversification is very important. I know it's a term that, we all repeat all the time, but one of the things that's always, really dangerous in a portfolio perspective is to just be exposed to those part of the markets that have done really well over the last couple of years. And if you think about in recent years, it's been a very interesting market where, despite market returns being really strong, if you look at some parts of the market, it's really been driven by a very narrow number of sectors and stocks. So you want to ensure that you're just not banking on a very narrow part of the market, carrying your whole portfolio. So diversification is important as well.
Yeah, thanks for that. I think that's a really good point you made about your portfolios having a bit of a handbrake on them in down markets. Equally, when they're going up, obviously you're saying you lag it. That's in investor speak what we call beta. But the return you're getting on a risk-adjusted basis is most likely better. So yeah, thanks for that.
Yeah, I think and that's a bit nerdy talk, which is what we do sometimes. And we saw that, speaking on behalf of Lonsec, but we saw that last year with a lot of our clients and the benefit from that the share market did fall pretty drastically with COVID, 37% in a month or something like that. And protection of capital, particularly when you're retired, from our point of view, is really important. And we saw that from the portfolios. And so it's important that our clients have benefited from that through that process. So that's why we work with experts like yourselves.
Certain sectors have benefited from the COVID environment, while others have suffered in recent times. What may be the possible implications for investors and in a post-COVID world?
Yeah, look, it's a good question, because if you look at companies, Australian companies, over the last sort of 12 months, it's really been a tale of winners and losers, and at the extremes. So if you think about companies, some of the retailers, particularly those with an online presence, and during COVID, everyone was locked down, everyone went crazy. I mean, I've got daughters, and I just had my doorbell ringing every day with some package being delivered, whatever it was. And so some of the retailers, your JB Hi-Fi's, etc., for example, had incredible
super cheap order,
Starley, everyone was doing home renos, whatever, so some companies just had incredible earnings and well in excess of expectations. Now, whereas on the other side of the spectrum, then you had some industries, you look at, obviously, your airlines are the notable ones, some of the infrastructure assets. So, people, Transurban or something like that, where, people obviously weren't driving around, there's people using toll roads and the rest of it. So you had a real sort of barbell of these big winners and these big losers, so to speak. And what I think is going to happen is as we things reopen and hopefully we get back to sort of some kind of normality, is that because when you think about the market, the market's trying to price future earnings. And it's probably fair to say that, would you expect some of those stocks that did really, really well in that environment, will their earnings continue at that sort of rate going forward? Probably not. They might be still strong, but the extent of it. And then conversely, some of those stocks that, your airlines is a good example that were absolutely battered in that environment. As we open up, as travel, we just was it today? I think it was international travel. We had people flying back into Australia and so forth. So, well, I guess that's a long way of sort of saying is that you might see a bit of a rotation in terms of some of the stocks that do really well. And again, that's why being active from a portfolio perspective will be important. And having, again, that diversification within the portfolio, that you're not just anchored to one part of the market that has done really well over the last 12 months, because the next 12 months may look a little bit different. So we are seeing a lot more divergence, a lot more opportunities, and so forth. But you probably, it is an environment that will probably suit more active approaches. They're not. I mean, an interesting one, just the final company one. I don't know if you guys saw, but I think it was the CEO of Woolies was actually saying that some of their sales numbers have gone down because as things have opened up, people are eating out more again and buying less. Just that sort of the general trend is buying less from so. It's all sort of related. It's all sort of you can see how it sort of impacts companies in different ways as we reopen.
People aren't stocking up on toilet paper.
Yeah, exactly. Yeah, exactly right. What we're seeing in the property prices at the moment is incredible. I mean, one of my good friends is a property valuer, and it's interesting in that what he says is that trying to value property today is just incredible, like because just the prices are out of control at the moment. So look, it's a fair housing affordability is absolutely on the cards. It has been for some time. I think what will be interesting to see is if the RBA has noted that house prices are getting pretty expensive. And we might see, and we already have starting to see a little bit of this already, but you may recall we had the APRA prudential sort of lending guidelines a while ago.
Harder for people to borrow
Making
more.
it harder to borrow, and I think that's possibly on the table again. We've already seen some actions taken to just take some juice out of the market. But look, it is a broader challenge. I mean, I think. I don't think there's a simple answer. I mean, we've got, in normal times, Australia has net migration. Our population has been growing. People still want to live in the, those larger sort of cities, so to speak, and there's finite stock. I mean, I think one of the, and this is a left field one, with the whole COVID environment and a lot of workplaces offering flexibility in terms of the workplace. It seems like there's a real structural element to that, and so if it means that people have and again, it depends what line of work you're in, but if people do have more flexibility in terms of working from home, and do you have to live within a sort of city area, so to speak, for certain jobs? Arguably that may, it may mean that people can live somewhere else. They don't need to be, in those expensive areas. I mean, but perversely, we've seen prices go up. I think everyone's moving up to Queensland now, right? So the prices are going up over there as well. And
no, the start on the coast, people moving from Sydney, they can sell their houses in Sydney wherever they are in Sydney. The median price in Sydney is, I think, $1.3 million now.
Yeah.
Can move to the coast and they can't believe they can be a kilometre or less from the beach for $1 million. And so we've seen a huge increase. Last night I was watching a show that had a couple have moved to Noosa from Sydney. She can work from home, so can he. They sell the house in Sydney, move to Noosa, living their life. So
So that might, I mean, longer term. I mean, I think longer term that will be interesting to see whether that makes. I mean, at the moment, shorter term, you're seeing that put prices up in regional areas as well. But yeah, I think from a practical perspective, it's going to be around lending standards, whether they sort of curtail that. If you see interest rates go up, you know, if there's a lot of people there that are pretty leveraged up, right? So if you did see interest rates go up by not a lot, I think that would put some pressure on some of the property prices as well.